We buy the car. We bought it with our bank. We took a loan from our bank. Now we're going to take the $500 we used to give to somebody else's bank and we're going to pay it back to here. Doing that with cars gets you all the money back for every car you buy, drive, and own. You just changed one thing, folks, where your money went. And then you treated your money the same way you would have treated the finance company or the bank's money. Welcome back, everybody. Another week of Wealth Webinar. Today, we are going to go deep, and we are going to go deep into the infinite banking concept. You know, privatized banking or those specially designed and engineered whole life plans or that thing with the life insurance. Comes by many names, many shapes, many sources, BOLI, COLI, IBC, private banking, lots of different names, but it all comes down to one sole thing: you taking back control of your money. This is what the wealthiest families in history have done. This is absolutely what you need to do. In these economic times where we're on the brink of another recession, and this recession, based on what Stephen and I have put together and based on all the research we do of all the economists, this could be the big one. And I don't mean to scare you, but you need to be scared right now. But scared should also drive you to take action. What we're going to show you today with this concept, with this process, this is how you will rise to the top. This is absolutely how you will go through a recession without any fear. This is how you will see the recession or any kind of an economic downturn as an opportunity instead of an obstacle. These are the things that we're going to cover today. And one of the things I want to start with is I want to start with this. I'm going to just share my screen because this is always how I like to get you guys ready for this. So first and foremost, how many of you own a business? In the chat, if all of you could just tell me if you're a business owner, put I in the chat. So as you're doing that, I'm going to take you through a little journey here. First off, if you owned your own restaurant, which some of you may, if you owned your own restaurant, would you bring your friends? Like when Drew comes into town, would you take Drew to your restaurant or would you take him to a competitor's restaurant? Chances are you would take them to your restaurant for many reasons. Number one, it's your business. You're proud of it. Number two, you control the outcome, which you don't when you go to your competitors. And number three, that's just what business owners do. If you owned your own hair salon, which clearly, if you can tell by my hair, I do not. But if you did, would you get your hair done at your salon? Or would you go across the street to your competitor's salon and all the people that work for you and all your customers say, hey, how come Steven just went across the street to get his hair cut at the competitors when he's got, why wouldn't you guys cut his hair? Of course you would go to your salon and get your hair done because you have pride in your business. Same thing with a gym. Just this morning, I went to the gym. Every morning when I'm at that gym, the owner is there. He's either coaching, training, or working out. I have never once heard of or seen the owner of the gym go across the street to the competing gym, which there is one right across the street. If you guys owned your own gym, of course you would work out. You would want your customers to see you working out. You would want your customers to see you training and like helping other people shape their bodies. You would have pride in your business. So if you owned your own bank, hypothetically, you would make deposits in your bank, wouldn't you? You wouldn't go to Bank of America and make your deposits when you own a bank. Of course not. You would hold your deposits at your bank. And when you needed money for that vehicle or that copy machine or that whatever, you would take loans from your bank, wouldn't you? Of course you would. That's how your bank makes money. And when you took loans from your bank, you would always pay your bank back with interest, wouldn't you? You would never steal from the bank. I mean, you don't steal from Bank of America, do you? When they give you a loan, do you ever just not pay them? Well, you know the ramifications of that. Your credit gets destroyed. They come after you. Sometimes they'll actually sue you. So if you owned your own bank, of course, you'd pay your bank back with interest. Well, that's the biggest thing that we're going to cover today. We're going to cover what that looks like and what that means for you to own your own bank. Now, I know when you're thinking about this, most of you are thinking about the brick and mortar bank, but that's not what we're talking about. We're not talking about a true brick and mortar bank. We're talking about the concept of operating just like a bank does. Banks are very simple in what they do and how they do it. But let me kind of go over some of the things that are problematic with this. First off, just like this behind me, This is Will Rogers, and I'll stand on this side. And Will Rogers says this. He said, the biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so. So what you think you know is that when you make money, you should go deposit it in somebody else's bank. This is just what you've been taught and trained to do. And when you need money, you go to a credit card, you go to a bank, you take out a home equity line, you take out a loan, whatever it is, you take a loan. It's just what we've been conditioned for. But you see, that's what we think we know that just ain't so. Many, many years ago, some of the wealthiest families, the Rothschilds, the Rockefellers, the Morgans, and the Stanleys, in one way or the other got together and said, you know what, we don't trust the banking system. And when they came up with the banking system being weak, they wanted to find a better place to store their family's wealth. So they started thinking and looking around and saying, where is the smartest place for us to put our family's fortunes? Because if it's not a bank, and they were all bankers, if it's not a bank, where is it? Well, through a lot of research, they found out that insurance companies, giant mutually owned insurance companies, were the most financially stable financial firms there were, period. They had all the money. They had all the security. They made promises and guarantees. So all these wealthy families needed to do was figure out, how do we deposit our money with these insurance companies? So I don't know if any of you have ever tried this, but go into your local insurance company. Take all your money, okay, you take it out of the bank, and then go in there and just say, hey, Mr. Insurance Company, I'd like to make a deposit. They would usher you, probably with security, out the front door and say, we're not a deposit institution. So they had to figure out how to make an insurance company look and feel like a bank. And it was very simple. Back then, there wasn't all the choices there are today. So they landed at one product, a product that had been around for the longest period of time, called whole life insurance. But in its typical normal shape, okay, it is a life insurance plan. And as Dave Ramsey and Susie Orman says, it might be one of the more expensive life insurance plans, which I would disagree, because term is the most expensive, because the insurance companies only pay out on 98% of those. So that is the most expensive, because even though it's the cheapest, it's the most expensive because it never happens 98% of the time. Whole life pays out 100% of the time unless they get you to lapse your policy, which they're very good at. So back then, those families figured out, we need to reshape or reconstruct this whole life contract. Because really, what is a whole life insurance policy? It's a contract. It's a contract between you and the insurance company, with lots of different things in there, but it's very simple from the nuts and bolts of it. They make a promise to you for two things. Number one, they're going to pay you a guaranteed interest rate. And the second promise they make is they're going to pay a death benefit someday when you graduate. Nice way of saying when you go to heaven. So as long as we understand the two promises that an insurance company makes when you sign an insurance contract, we understand the baseline of how they did this. They said, if that's what a contract promises, and really what we're after is that guaranteed interest. Oh, and mutually owned insurance companies pay dividends every year because they have no stockholders. So because there's no one standing in line to collect their stock dividends or their stock increases, they don't have any outside people to answer to. You, the policy holder, or the Rothschilds, Rockefellers, and all these families I'm talking about, they are the single most important people. They are like the stockholders to a mutually owned insurance company. So numero uno is the policy holder. So the insurance company pays the policyholders dividends, and they have consecutively every single year, not missing 1 year, at least not the companies we use, which we'll talk about what companies those are for, like probably one of the first times that we've talked about it. They've paid them consecutively every year through the Great Depression, through the hyperinflation of the late 70s and early 80s, through the recessions of the 70s, the 80s, 90s, through the Great Depression, through Great Recession, all of them, they paid dividends, never missing one. So these wealthy families said, we've got this great contract that has these great things. Oh, and by the way, it's tax-free. And because we have all the money, we can control the tax code, which came out in 1913. So when they came out with the tax code, all the guys got together when they were creating the tax code and said, hey, these things, these whole life things, that's life insurance. Let's make them tax-free. Let's make them bypass the tax code. And that has held up since 1913. And it will never probably go away, because guess what? All the wealthiest families use this and have their money in this. So why would they ever jeopardize their family's fortunes? They wouldn't. So now you're starting to see it. But when they started constructing the contract, they had to find a way to get the maximum amount of return for their money and make it so that the insurance company received the least amount. And that was very simple. They had to take a contract and they had to flip it upside down and spin it around to make it so that the death benefit on the contract was the lowest it could be, and the cash value was the highest it could be. That's it, folks. When you go to your insurance agent, your financial advisor, when you walk to your broke ass brother-in-law when he comes over trying to sell you an insurance policy, he's trying to sell you a death benefit, right or right? Stephen, how many times have people you known tried to sell you a life insurance policy? What do they say? Well, what would you like? Would you like a quote on a $100,000 policy, a $200,000 policy, a $500, $1 million policy? They're always selling a death benefit, are they not?
Yeah, I mean, that's life insurance, right? How much death benefit do you need? That's the discussion.
Yeah, all I was ever taught at New York Life, sell a death benefit. Great. Well, you figure out through a needs analysis how much the person is worth dead, and you solve for the life insurance, how much debt they're trying to protect. It was always selling a death benefit. And guess what? The agents, the advisors are compensated on the death benefit because guess what the death benefit has? A cost. It's called the cost of insurance. So the more death benefit we have, the higher the cost of insurance, the more commission I make. Beautiful for the advisor, terrible for you. Terrible for the Rothschilds and Rockefellers. So we had to build it so that the death benefit was the lowest, the cash value was the highest, and who suffers in that equation? The agent, the advisor. Their commission, just in the nature of how these are created, which we will go into today, is cut 60 to 90%. So are you guys following this? Now, a lot of agents say they know how to do this. We have been going around, traveling around, and it seems like everybody today hears this buzzword IBC, and every advisor seems to say, oh, I can do that. Great. All right. Well, show me. Put together a plan design. Show me that you know how to do this. I'll bet you any money, less than 10% of all the advisors, all the insurance agents that you will ever deal with will know how to do this. Actually, matter of fact, most of them will say, oh, you don't want a whole life. You want to buy one of those fancy IULs. That's a major red flag and a major mistake. And if any of you follow this guy, Curtis Ray, okay, I've got it out for this guy, and that's all right because we're going to fist fight someday, but that day will come. We'll make sure we try to televise that and show you. I'll win. I'm just saying. I usually don't bash people, but you know what, Curtis Ray, bring it on, buddy. I'm ready for you. I'm ready for the ring. Anyway, putting that aside, IULs do not work for the infinite banking concept. They can't, and they won't. So anyone that says that an IUL is what you should do, they have no idea what this concept is. They say they do, but really they're chasing a commission because IULs pay one of the highest commissions unless it's done the right way. And there's only two people that we've found so far that actually know how to design them the right way. And it requires those agents, Sammy and Jonathan, to reduce their commissions 92%. So imagine this. You go to your financial advisor who's been in your family and been working with you forever, and you say, hey, listen, I want you to design me one of these infinite banking concept whole life policies. And they say, okay, great. Yeah, I can do that. How much do you want? How much do you want me to do the plan for? In their mind, they're thinking, how much death benefit? And you're thinking, well, I don't know. I think I'd like to deposit $100,000 a year. Can you design it around that? Oh, yeah. First off, when we design these, we design them around your premium deposit, not the death benefit. The premium deposit's the only thing that matters, and it's different for everybody. One person's $200 a month, another person is $20,000 a month. There's no variations. It's whatever your needs and goals are. But if we design it based on death benefit, we're designing it wrong right from the get-go. Because the premium that you're going to put into the policy is what's going to drive the death benefit. The more premium, the more death benefit we need. Okay, so it's a very simple equation, and I'll put it up on the board here real quick, just so that we can understand this. So if we've got cash value and death benefit, the only reason we have to have a death benefit is because it is a life insurance contract. We can't call it anything else. We can't eliminate the death benefit because then it wouldn't be a life insurance contract. Now, after 1988, they came up with what's called the MEC 7-pay rule, okay, which limits the amount of cash you can put into the policy based on the amount of death benefit you have. Now, this is a sliding scale. There's no one metric that works. It's based on health. It's based on age. But let's just assume this. Somebody wants to deposit $100,000, okay? And we'll just use like a 60-40 basic design. There's lots of designs. Let's just say that gives them $70,000 of cash value immediately in the first 30 days. That $100,000 deposit, which gives them $70,000 immediately, is going to require a death benefit of, let's just call it $2 million. Now, an agent would sometimes want to put a full $2 million of base on that policy, okay? Now, we don't need to know and understand what these are, but just understand that the base is one of the more expensive, but one of the most valuable in the long run. How we would do it is we would say, okay, let's not do that. let's actually, if we need $2 million to support this thing, let's put 700,000, and there's a way to do this that we figure out. Let's put 700,000 of base on, and then let's do 1.3 million of term insurance. Now, you guys have all heard of term insurance. Why do people buy term insurance? There's one word. It's cheap. It's the only word. It's cheap. It's why people buy term. It's why insurance companies advertise term. It's why Dave Ramsey only talks about term, because he's working for the insurance companies and that's how he's compensated. Term is cheap. So we use term insurance, but we only need term insurance on the policy for 7 years. So we'll put term insurance on for 7 years. And after the 7th year, we eliminate it, dropping you down to the base. But you see, at that point, the base wouldn't be 700,000. The base probably would have grown to something like 1.4 million. That automatically has to go up, because as your cash value goes up, your death benefit goes up. So I know I'm getting a little in the weeds, but I first and foremost just wanted to explain a little bit about how these are constructed, why your financial advisor probably doesn't know about these. And not only that, I wanted to make sure we got out of the way right in the beginning the main understanding of the plan design. There's term insurance on only if we need it. If we don't need term insurance, we don't put it on, because it does add an added layer of cost. And it's going to be an added layer of cost for 7 years, because we drop it in the 8th year. That's the only reason it's on there. All right. So now, Stephen, where should we go from here? Should we go back? And here's one other thing I want to show everybody. This is pretty important right here on the screen. I'll blow it up for you. Now, a lot of people, are skeptical about this, because they're like, well, why doesn't everybody do this? How come I've never heard of this before? Well, a lot of people do this. A lot of wealthy families do this. And the number one purchaser in the world of whole life insurance are banks. And there it is right in front of you, FDIC.gov. You guys can all look it up yourself. That says of September 30, 2021, the top 5 banks own $75 billion. If we add all the banks in there, it's over $200 billion. That's how much whole life insurance they own. They call it bully. So when you're actually thinking about this, trust me, like, banks are well aware of this, very, very well aware of this, and they use it. That's why there's so many vice presidents. So real quick, now that we have to understand why we do this. All right, so let me get rid of this screen. I'm going to bring up another screen. We first have to really kind of understand, why would somebody want to do this? And I'm going to do it by just walking you through something that many of you have already seen, but you can't see this too many times. And I know that because I've done this hundreds of times. So let's get the right color here. Let me get a red. All right. How does a bank actually work? So if we're going to be a bank, if we're going to operate like a bank, we have to understand what a bank does. We have to understand the basic fundamentals of how a bank operates, their process. Well, it's quite simple what a bank does. You all know it and you see it. You just don't look behind the curtains. All of you deposit money in a bank. So we're just going to talk about a $100,000 deposit going into a traditional bank. And let's just pretend that that bank pays you 4% interest. Now, I know none of you are getting 4% from your traditional bank, but let's just pretend that you were, okay? If you were earning 4%, then this deposit is an asset. When you go to the bank, when you go to the car dealer, they want to know how much money do you have in the bank, because it's your assets. It's on the asset side of your balance sheet, okay? Your budget or balance sheet. But to the bank, that deposit that you just made is a liability. So the bank has to turn liabilities into assets, as says Robert Kiyosaki in his book. So to make this deposit you made, the liability to the bank, an asset, they have to lend it out. And that's what they do. Mortgages, car loans, home remodel loans, debt consolidation loans, they do this every single day. When you go to the bank and you take money to the bank and you give it to the teller's not putting that money in a little box with your name on it in the vault. That money is going to work for that bank right then and there. There's people in those glass cubicles that are working on loans that your money will go to. The bank takes your hard-earned dollars and makes it go to work for you and pays you little to nothing. And in this example, it's 4%. And people are just okay with that. You know, as one person said, it is what it is. No, it's not. It's your choice. You don't have to give up control of your money to somebody else's bank, but you do because that's what you've been conditioned to do. And while the bank does this, the bank makes loans at a higher rate than what they're paying you. So if they're paying you 4, let's just assume that the loan they're making is 7. The car loan, because a house loan would be one of the lowest risks for a bank because they have the house as collateral in a first position. Okay, they're numero uno on that. When they do a car loan, they're first position, meaning if you don't pay them, they come take the car with one of those flatbeds. Hopefully none of you have dealt with that. But when they do a car loan, it's slightly higher because, hey, if you don't pay them, they got to chase the car. The house doesn't move, the car does. So it's slightly higher, 8%. Okay, and then the money goes back in. Each one of these times, the money comes back to the bank, goes back out. 9% for the second position home remodel HELOC, and then 12% for the debt consolidation loan. So you can see how this works. Money goes in, money goes out. Money goes in, money goes out. Money goes in, money goes out. Every one of these transactions here, who was in control? I mean, it was your money at the beginning of the day, right? It was $100,000 of your money. Did you control all these loans? Not at all. The bank did. The bank took as much risk as they wanted to. The bank charged any interest rate that they wanted to. You had no say in it at all. The only decision you had to make when making that deposit is, did you want the grape, the strawberry, the cherry, or the watermelon, dumb sucker? That's your only decision you have to make. And then maybe on the way out, if you want some of that burnt, chalky coffee that they have, you could have grabbed a cup of that too. The bank is in full control, and the bank controlled the risk too, and they didn't take much risk because each one of these was secured by a house, a car, a house. And then here, that's the only unsecured one, but they charge 12%. So if we were to do the math, here's what a bank does every day. And this is exactly what all of you need to do and what you need to learn. So the whole process, the infinite banking concept, is simply this. The infinite banking concept is you taking back control of your money and taking back the banking functions in your life. Let me repeat that again. The infinite banking concept is simple. It is you taking back the banking functions in your life. What are all of these? Banking functions. Starts with the deposit. You take back that, okay? Loans, you take back that. Car loans, everything. You take back the banking function. And in taking back the banking function, you're in control of all these decisions. You're in control of what you loan, how much you charge. You're in control of the security and the collateral. You control it all, which for some of you is confusing. You're like, oh, I don't know how to do this. Of course. When you got your first bicycle, you didn't know how to ride a bicycle. And I bet you there's not one person on this webinar today that cannot ride a bicycle. All of you know how to ride a bike. Same thing with banking. All of you right now might say, I don't know how to do that. I don't know. Great. It's a challenge. You can learn, and you can literally learn inside of 30 days or less. You could read one book and learn, or just do this webinar and we're going to teach you. The whole idea here is if the bank paid you 4, and the bank charged 7, what did they make? They make a spread. If we add all these up, okay, the spread works out to be 20%. A bank is in the business of making a spread. If they pay you 4, they charge 7, they make a 3-point spread over and over and over again. So when we become the bank, when we take back the banking functions in our life, all we have to do is change one thing, add one step to your life, and that is where your money goes first. Instead of your money going into their bank, okay, as I just represented, whatever your name is, I want you to insert that. For this purpose of this training, this is going to be the Chris Bank, okay? So now the bank is me. Now, what is my bank? My bank is nothing more than a specially designed and engineered whole life, because the money has to go somewhere. We have to warehouse our money somewhere. So why would we use a whole life insurance policy? It's simple. There is nothing in the financial world, in the world, that does what a whole life can do. And I'll explain that in a second. The first thing I said that a whole life will do, so if you change one thing and you change the name on the bank, so now you've got a whole life insurance that is specially designed to do what I'm going to show you. The first thing I said that the insurance company will do is they will give you a guaranteed interest rate. Remember I said that earlier? The wealthiest families were seeking 2 guarantees, a guaranteed interest rate and a guaranteed death benefit paid out when they die. So we got the first one, guaranteed interest rate. Now, I know I said 4%, and this is an old slide, but now let's just use 3. Say the insurance company pays you a guaranteed 3%. Now, let me ask, and you guys can chat this in. If the insurance company pays you a guaranteed 3%, is that better than what you're earning right now at the bank? Yes, you can type it in the chat. If the insurance company pays you a guaranteed 3%, is that better than what your money market's earning? If the insurance company pays you a guaranteed 3%, is that better than what your CD earns? Is that better than what your treasury bond earns? That's the only one that would get close. Absolutely yes. It's better than all those. The treasury bond right now might pay us slightly more, but now what we're going to do, remember I said they don't just give you a guaranteed interest rate, they also pay you a dividend. So all the companies we work with after the dividend is paid, going to bring you to 5.2 to 6%. Okay. I just want you to remember those numbers. It's about where you're going to be at, not just 3. It's 3 plus the dividend. So you're earning 5.2 to 6%, which is absolutely better than any other place you can put your money. Now, some of you might be thinking, yeah, but we hear that a lot. I always say, yeah, but is a 3-eyed animal that lives in the woods. If you say, yeah, but interest rates are going up, so my bank account might pay me more in the future. Interest rates are going up, my money market will pay me more in the future. Interest rates are going up, my CDs will pay me more in the future. Then I'm going to come back and I'm going to say, yeah, but when interest rates go up, which they are, treasury bond rates go up, which means dividends go up. So if you think you had us beat because all your things that you have your money safely stored in that pay you hardly anything are going to go up in the future, I can't tell you this for sure, but I can tell you based on history, chances are ours are going up too, because we're at a 32-year low on dividends, the lowest I've ever seen, and I think one of the lowest in history with these insurance companies. So this is a great time to look at this. You know, sometimes when you throw a party, you're like, oh, that was a great day to have a party. It was sunny, it was nice, little breeze. This is a great time to do this because we're not doing this at a high point. We're doing this at the lowest point. So the numbers we're going to show you in just a second are based on the lowest dividends in 32 years. So right there, that gives us a lot of confidence saying the only way we can go is up. The only way the stock market's going to go is down. The only way crypto is going to go is down. You got a winning horse right here. And it is this boring, stupid, specially designed whole life. So now if the insurance company, let's go back to some math. I just want to drive this home. Remember, the bank made a spread of 20%, which was 5 times or 500% more than what you were earning. Because remember, you were making 4, the bank was making 20 on the spread. That's 500% more than you. There's not a bank in the world that makes less than 400 to 1,300% more than you are, just to put things into perspective. So now we change where the money goes into this specially designed whole life. And now we're going to take back the banking functions. Well, let's just use 6% because it's easier math. With dividends, if you're earning 6, okay, if you're earning 6 and you have to pay 4% for a loan, what's your spread? 6 minus 4 is 2. Right out of the hole, we're making a 2% spread. But you see, here's the best part. That spread that I just mentioned, 6% you're earning with dividend, minus the 4% that the insurance company charges you to take part of your death benefit, you're making 2%. And we haven't even gotten started because you haven't even started to do any banking yet. Now you take that money, and we're still using 100,000, but it's going into your bank. When we take this 100 grand out to buy a piece of real estate, and I'm just going to use simple numbers. We put 100 in, and let's just say we take 100,000 out. Right there, when we took the 100,000 out, most of you would do the math. You would say, okay, if I had 100 in my bank and I took 100 out, I got 0 left. The bank would pay me nothing. But if I move it to an insurance company and I put 100 in the insurance company and I take 100 out, I technically have no money in there. But wait a second, that Chris and Steven said, when I take 100 grand, I'm not using my money. I'm taking part of my death benefit that the insurance company promised. We're just going to use $1 million, okay? The insurance company just lets me use some of my death benefit as a loan, and my money never leaves my account. So you got 100,000 in your account, earning 6%. You take 100,000 out to buy a house. The 100,000 never left your account because the insurance company gave you 100,000 of your death benefit early. And all the insurance company is going to do now, if you die the next day, they're only going to pay 900,000 out to your beneficiaries. Why? Because they advanced you 100,000 of it. They don't care if you ever pay that loan back because the insurance company has actuaries that can tell you the day you're going to die in a large group. It's a freaky thing. Sit on the beach drinking Coronas with an actuary and you start to really question life. You're like, wait a second, I'm going to die when? Well, you're going to die at about 76 and a half. Are you healthy? Do you smoke? Blah, blah, blah. Yeah, you're going to die at 76 and a half, give or take 77. Wow, perfect. Now I know what the day is. Actuaries can do that. So the insurance company knows that no matter what, if they give you part of your death benefit today, they're getting paid. They might have to wait 60 years, 40 years, 30 years, however old you are, but they're getting paid. They're getting their money back. So by them lending you that $100,000 of the death benefit, it's just a balance sheet item. Okay, got a $100,000 liability here, promise to pay out the day you die. We're just going to shift that liability over here, and we're going to make it an asset, like a bank. They're going to lend it to you at a rate of 4%. So now all of a sudden, 4% is the rate they're lending it out to you. And this rate changes, but I'm just using one of the companies we use called Mass Mutual. The 6% is Mass Mutual, the 4% is Mass. So we're starting to get into some of the companies we use. Mass Mutual is one of them. Lafayette Life is another. One America is probably our all-time favorite. And then Guardian is another one that we use, and sometimes Penn Mutual, but very rarely. There. What insurance companies? I just gave you them all. Okay, there's not a lot of them. When you took the 100 out to buy the house, you're making a spread. 6 is what they're paying you. 4 is what they're charging you. The spread is the amount you get to keep. Does it sound a lot like what the bank did? It's exactly the same. The bank paid you 4, lent it out at 7, they made a spread. But see, here's where you being the bank actually works even better. You get to make money twice, not just once. 6 you make, 4 you pay, make that spread. Now you buy the house. Let's just say the house you bought for 100 grand, you Airbnb it. And over the course of the year, you only Airbnb it a couple times a month, but you make a return of 7%. Okay, fair enough. It's a pretty low return for Airbnbs, but we're being conservative. So now you took this asset that you bought with a loan from your bank, which is the whole life, and you now Airbnb'd it, or Airbnb'd a couple rooms, and you made 7% on that 100,000. How many times did you make money? Twice. Okay. Now let's just say you don't want to buy a house. And all you do, here's the one thing you got to do with the infinite banking concept. I didn't cover this. So I'm going to get rid of this slide. Everybody understands how a bank works, and how a bank makes money is a spread. And if we just change where our money goes first, we get to make the same spread, and then we get to make money by making our money go to work. Everybody's got that, right? Do we have any questions, Stephen, that came up on that part?
No, not really. I've been responding to someone here, but no question. Oh, actually, let me check the Q&A.
Yeah, check the Q&A. I don't want to move on until I've got all the questions out, because I'm doing this different than I've ever done it. But believe me, we're going to get to the same destination at the end of this.
No, we're good right now.
Okay. All right. So let's just use this one. So now we understand how this thing works. And again, I want to be clear. You know, I used 100,000 on the last one. The amount doesn't matter. So let's just dump it down, and let's change the 100 to $10,000. Every year you're going to make deposits for 10,000. And the amount that you deposit doesn't matter. It's up to you. It's the amount you're saving today. How much are you putting into the 401k? Great. That's the amount you're saving. How much money do you save in a bank account every single month today? How much money are you saving in a money market? How much money are you putting into crypto? How much money are you putting into the stock market? These are all things that you save. We're changing one thing, folks, and that's where your money goes first. That doesn't mean that the money goes to the whole life and then you can't do any of those others. This is not the and or asset. This is the and asset. Okay. So it doesn't mean that you can't do this and buy stocks and buy crypto and invest in whatever you want. You do them both. Why? I just told you why. If you change where your money goes first, you make a spread just for doing that. The insurance company pays you this, they charge you that, there's a spread, and every year that spread goes up. So if we just put 10 grand into our private bank, and just remember our private bank is the whole life. Now, what else can we do? Now, I'm not going to get confusing with this segregated account. All I want you to think of is this is a stopping point. Books and records, okay? Segregated bank account. Any of you that have seen our videos, I don't want you to get too hung up on this. All this is a just a brand new checking account. Go to your bank, open a new checking account. That's all this is. The purpose of the segregated account is books and records, just so you have a clean slate to track money in and money out for your banking, because there's not a bank in the world that doesn't have a back office tracking the amount of deposits that come in and the amount of loans that go out. You need the same thing. So what we've figured out through our ultimate wisdom and how smart we are is, let's open a brand new checking account, and let's do nothing else with that checking account except for take money from our private bank, put it in there, and take money from the recapture and put it back over here. That's all we're going to do. Okay, so we got 10 grand in here. Now remember, if that money goes into your bank, you're making 5.2 to 6%. When we take that money out, we take it out as a loan, and the loan is going to cost us, we'll just use 4%. Okay, this is the loan cost as of today. And that is a variable rate, but insurance companies don't change the loan rates the same way banks do. They're not tied to all the things are. They change it based on guaranteed rates. I've seen loan interest rates change very little in the almost 20 years I've been doing this. So we right now can see the spread, 6 minus 4 or 5.2 minus 4. You guys got the first part of the spread. But the one thing I want you to understand is because that now is ingrained in your head, the spread, 2%. It's 2% this year. Next year, it's more than 2%. The year after that, it's more. Does anyone know why? Because if we start with 10 grand and we make 6% gross, okay? We're not talking about cost of insurance. There is a cost in there, but we're just doing gross numbers. So the second year, whoops, let me do it down here. The second year, how much money are you starting with? Is it 10,000? No, the second year you're starting with 10,600, and 10,600 is earning 6%. So now the next year after that, it's more. What is it? 10,000 or 11,000? It's like 11 and change. I don't know, 11,500. Let's just say. I'm not doing the math because this is where compounding gets complicated. Our brains can't do the math. Every year, whether the money's in your bank or out of your bank working, it's earning interest, uninterrupted. Albert Einstein calls this the eighth wonder of the world. The most powerful thing in the world, those that understand it, earn it. I'm showing you how to earn it. Those that don't, pay it. Most of you are paying it because you're taking loans from somebody else's bank, you're using credit cards, so on and so forth. So you see, every year, your spread goes up, and it didn't require you to do anything. It just required mathematics to do its part. So now let's really discuss how this works. We understand the first part. We're going to change one thing, and that's where the money goes first. But now let's get into the second part. Once you put money in your bank, the money's got to go to work. Because sitting in the account, great, you're making 6% if it's Mass Mutual. Whip-de-freaking-do. Like that's not going to move your needle. It's better than what you're doing now, but it's not going to move your needle. We need to make our money go to work. It's the second law of wealth. Your money must work for you. So how do you make your money go to work? Lots of ways. Let's start with the simple ways. How many of you have credit cards that you don't pay off every single month? I bet you a lot of you. And if you have credit cards, I'll bet you any money you guys are paying, guys and girls are paying 15 to 20%, and that's going to go up with interest rates. So if you're paying 15 to 20%, let's just say your credit card is $500 a month. We have 10 grand that we put in here, and let's say you owe $8,000 to your credit cards. And that $8,000 credit card balance, you're paying $500 a month, just making numbers up. We take a loan from our specially designed whole life, our bank, we pass it through the segregated account. So we take the loan, we deposit it, we immediately take that money out, and we write a check. Okay, and it doesn't have to be a check, it can be a bill pay, but just want you to get the visual. We write a check to then pay off the credit card balance. So we took $8,000 from our bank, we paid off the $8,000 in credit cards that we had. This is where the biggest mistake is made. Right then and there, most people, that's it. They're like, I'm done. Great, I have no more credit card debt. You're not done. Because if you stop there, you are stealing from your bank. Because remember, early on, I said you would take loans from your bank. You said yes. And then I asked if you would pay your bank back with interest and dividend or interest in principal. And you said, yeah, of course, I wouldn't steal from my bank. If you take a loan for $8,000 from your bank and you pay off the credit cards and you stop there, you just stole $8,000 from your bank. Forget about the fact that the insurance company doesn't care if you ever pay the $8,000 back. You still stole from your bank. You're not taking back the banking functions because you're not acting like a bank. There's not a bank in the world that would give you $8,000 without that money being repaid. Therefore, you must act the same. You are okay giving the credit cards $500 a month. That's just what you were paying them. So all I would do is I would take that $500 a month. I would set up a bill pay, the same amount, $500 that I used to give the credit cards, and I would have that $500 go into my segregated account, and then I would have that $500 repay the loan to my bank. You know what the coolest part about this is? How many times did you make money here? I said it earlier. 2. You made a spread, okay? The loan cost you 4%, but you were making 6, so you made a spread. The second way you made money is you took back money that you were giving away. And let's just make it 20%. 20% interest that you used to pay to the credit card, you're now the exact same amount, $500, which is the same as giving 20%, is now going back into your policy, your bank. And the best part is $500 every single month you do this is $500 more you have in your bank to use the very next day. But some of you are thinking, okay, yeah, Chris, but I don't have credit cards. Great. How many of you drive a car? So let's just say you have this for a couple years. You put $10,000 each year. Now you got 30 grand. Okay. So now instead of 10 grand, we're going to bump this up to 30 grand. 3 years have gone by. You have capitalized your bank for 3 years. You've paid off your credit cards. You've paid, you bought your cell phone so that you're not financing it with the cell phone company. regardless of whether it's 0% or not. It's about controlling your money flow. Anyway, you've used it for 3 years, you have 30 grand. So we go out and we buy a new car for 30 grand, or we pay off our existing car for 30 grand. A $30,000 car payment is probably $500 a month, maybe a little bit more. And let's just say a car loan right now. Now, I know some of you have been preconditioned the last couple of years to be able to get car loans for 0 or 1 or 2%. Those days are gone. I think everybody knows that, right? Nobody still thinks that in the next couple of months, you're going to be able to go to the bank and get a car loan for 1 or 2%. You guys know that's gone, right? Okay, good. Car loans absolutely are about 5%. So now the same thing. We buy the car. We bought it with our bank. We took a loan from our bank. Now we're going to take the $500 we used to give to somebody else's bank and we're going to pay it back to here. Doing that with cars gets you all the money back for every car you buy, drive, and own. You just changed one thing, folks, where your money went. And then you treated your money the same way you would have treated the finance company or the bank's money. So these are the simple foundational ways that this works. There's nothing complicated. This works for debts. This works for cars. This works for college. This works for boats. This works for vacations. You want to know how it works for vacations? Shauna, our director of operations, has a small policy that she basically builds up so that every year she can take a loan from her policy and her and her daughter go on a vacation to Disneyland or Disney World, whichever one they decide to do. And then she just repays her bank back a small amount every single month, repaying for that awesome experience she just created with her daughter. So vacations, it works for homes, HELOCs. It works for every single thing you can possibly imagine. Stephen, what questions do we have that we can dive into about that? And I also want to make sure that we hit as many of those questions in the beginning.
Yeah, I was responding to some just through text.
Interest charged on the whole life policy loan goes back into your policy. So Eve just caught something. Remember I said, so the insurance company is going to charge you a loan interest rate of 4. If your policy pays you 6 and they charge you 4, you've already taken care of the loan interest rate. The 6 they gave you minus the 4, I just do it over here. Now, some people don't like to do it this way. Some people want to say, okay, I'm going to lend the money out at 12, okay, on a real estate deal through Private Money Club. I'm going to lend that money out at 12%, okay? What they would do is they would take the 12 minus the 4. It doesn't matter how you do the math. You're still making money twice. Whether you take the 4% loan interest from the money working for you, or whether you take the 4% loan interest, which is how I do it, from the amount the insurance company is paying, it's all the same. The 4% loan interest the insurance company charges you gets paid back to the insurance company. One time a year, they're going to send you a statement, and on there, it's going to show how much the loan interest is, and that I write a check. So every year I get that statement. It says loan interest due, I don't know, $3,000. I just write a check for $3 grand. I don't even think about it, okay? Because I've already made it. I already made it with the 6. Or some of you want to do it this way. You already made it with the 12. But it doesn't change the dynamic, Eve. You made money twice, whether you take it from the amount the insurance company paid you a dividend, or whether you take it from the car loan or the private loan or whatever you're doing, it's all the same. So don't overcomplicate that. Doesn't matter which side you take it from. It's just mathematics, okay? Can you deposit your pay every week into the life insurance policy? Jim asked. You cannot. So it's the modes for how you deposit money. So the amount that's going in can be monthly, quarterly, semi-annually, or annual. The most lucrative is annual because all the money goes to work immediately. I do a lot of my policies. I have 9 of them, and I do a lot of them monthly just because that's how my cash flow works. So if any of you are like me, your money comes in monthly, therefore my savings goes out monthly. That's just how I operate. I have a couple that are annual. My daughter's policy is annual. My wife's policies are annual. And for that, I just got to have extra money. But I just don't do a lot with annual because that would require me to save money somewhere else. And I'm so deep down this rabbit hole that all of the money I save starts here. The only thing I don't use my policies for is household expenses, utilities, groceries, diapers. The normal monthly expenses, I use a regular checking account, which requires me to keep less than $10,000 at any given time in a regular bank. And to me, man, I feel like I'm winning. I do. The less money I keep in somebody else's bank makes me feel like I'm freaking winning the game. Because when I then pull up, I use a cash value line of credit, but when I pull up my policies and I look at the hundreds of thousands of dollars I have there, same thing. And if you were to go, a lot of people are like, oh yeah, but what if I go to take out a loan for a house? I'm a real estate investor. Like are they going to look at the cash value? Absolutely. Look at a personal financial statement, folks. I wish I had one I could pull up. Personal financial statement on the asset side, first line, cash in the bank or cash on hand at bank. Line number 2, cash value life insurance. Number 2. Okay. I know it's not 1 because the bank doesn't control it, but number 2, it's the same thing, folks. Whether it's in the policy or in the bank account, any financial institution is going to look at it the same. They're going to look at it as cash because they know it's guaranteed and they know it isn't going anywhere. And banks particularly, tongue twister, they love life insurance because they know if you die, there's a benefit being paid out. So when you do a cash value line of credit. So for example, cash value line of credit, let's say I got 100K in my policy. And if my loan interest rate in my policies is 5%, the new ones are 4. Well, let's say it's 5. I found that if I go to a bank, a traditional bank that does lines of credit, there's specific ones, I can get a line of credit, like a home equity line of credit. And they would only charge me, right now I'm at 4.25. So pretty soon I'll probably stop using cash value lines of credit. But for right now, I'm at 4.25. So I'm making a spread of 75 basis points. But for most of you, you're just going to use the loans from the insurance company, which is 4. Lien on your policy. Yes. So Andy, just so you know, cash value line of credit, just think of a cash value line of credit just like you think of a home equity line. When you go to the bank to get a home equity line of credit, the bank gives you a line of credit based on the equity in your house, and they put a lien on your house. So in the world of life insurance, banks are the #1 purchasers of whole life. So they will give you 100%, if your credit score is good, they'll give you 100% of your cash value, just like that. The application is 1 page. You ever gone to a bank and got a loan with a 1-page application that was approved in a day or 2? No. Cash value line of credit is, because just like Andy said, the policy is the collateral for the line of credit. So if I've got 100 grand, my cash value line of credit is 100 grand. And the cash value line of credit is secured or collateralized by the money in my policy. So I can't take the 100 grand out of my policy anymore because now I have the 100 grand available to me through my line of credit at a lower interest rate. Hopefully that makes sense. And that's only going to work. And I just want to be clear, the cash value line of credit is only going to be something you folks will use if you have cash value over, I think the minimum one is 80 grand. So if you got cash value over 80 grand, we should probably talk about a cash value line of credit. Otherwise, I want you to erase that whole thing from your mind. It isn't going to work for you. All right.
Couple things. So just go over kind of like what it takes to get started. Do you have to get rich? Do you have to be rich to do this?
No. You just have to basically understand that I'm ready to go. I understand this and I want to start. So the first thing we got to figure out is how much do you want to deposit into the policy? Okay. So what is in deposits, we call them premium deposits. And many of you have probably been on the phone with me. If you get on the phone with me and you say, my premium is due, or how much is that going to cost me? Or I have to pay. That's the biggest thing I hear. I have to pay my premium. That's like, honestly, like go to the chalkboard and just drag your fingernails down. That's what that is to me. You're not paying anything. This has to be viewed as a deposit. It is a premium deposit. So the first thing we got to figure out, how much money do you want to put into this thing? Because there's 2 numbers we got to figure out. Number 1, do you want to dump money in? So what is a dump in? Here's a dump in. Watch closely. I've got a stack of money sitting here in Bank of America, earning 1%. It's sitting here. I just hear these 2 guys talking, Chris and Steven, about this new thing, this specially designed whole life that can pay me 6% gross. So a dump in is I take this money from Bank of America, I move it from my right hand to my left hand. The left hand is the whole life. The right hand is the bank. The bank now has no money. My policy now has whatever money's in there. Call it 50 grand. Why would you do that? 1%, 6%. 1% taxed, 6% tax free.
Uninterrupted for the rest of your life.
That's the dump in. It is a one-time shot.
And then of the dump too, I mean, you're going to have access to like 90% or more of it too right away.
Yeah, it's definitely 90.
Immediately it gets in there, starts that uninterrupted guaranteed compounding for the rest of your life. It'll pass down, become a legacy for your family. And immediately within 30 days, you're pulling over 90% of it back out. So it's a win-win.
If you want to know if your agent or your advisor does this right for you, the first thing you would understand is if this is done right, if we design this for you at the Money Multiplier, whatever money you put into your premium deposits, dump in or premium deposit, you're going to have access to that immediately in the first 30 days. If you watch my case studies, you'll see clients of ours that have taken money out 2 days after they deposited it. But we always just say immediately in the first 30 days. So if you talk to your advisor and you want them to set this up because you've got a relationship and they can't do it so that the money is available to you immediately in the first 30 days, they don't know how to do this, call us, okay? 30 days is the max that it will ever take for you to have access to this money. And a lot of people then say, well, how much will I have access to? Easy, 60 to 90, well, actually it could be up to 92%, okay? 60 to 92% of whatever the money is you dump in or put into your premium deposit, okay? So the first thing we need to know is how much do you want to put away? How much do you want to have the ability to save? If you say to us, I want to save $500 a month, and I get this all the time, so please pay attention because I'm trying to just get this out so that you understand this. If you tell us you want to deposit $500 a month, no problem. That's the amount you want to save. But then you say, well, yeah, but like I'm expecting a little bit of extra money, like halfway through the year, if I get a raise, can I put $1,000 a month in? The answer is no. If you tell us 500, we're going to build the policy design to hold $500 max, okay? So 500 will be the most you'll ever be able to put into the policy because we design it right to the MEC 7-pay rule. You might be able to put 505 in. That would be about 510 maybe. That's it. But the beauty is after the first year, let's just say you hit hard times. The recession kicks in, you lose your job. You committed to 500 a month. Now you're like, shit, I can't do 500 a month. Great. You have the ability to reduce that anywhere between 60 and 90%, depending on how we design it. So let's just use 200. You can go from 500 down to 200 and then go from 200 back to 500. That's your range. Ceiling, floor. It's usually going to be 60% variant, okay? Could be up to 90%. So if you commit to a policy for $500 a month, you can always go lower, but you can never, ever go higher. That's why I have 9 policies. My first policy I started, I was 23 years old. 200, it was a little under this, but let's just round it up. $230 a month is how much I put into my first policy. So when you all say, what's the smallest policy I can do? I got it for you. Here's how you do it. What is the minimum amount you can put into this? How old are you? Okay. Take your age, and I'm just going to do mine. I today am 44 years old. And I want to know, I'm seeing this thing that Chris and Steven are showing, and I'm like, well, what's the minimum? Take your age and add a 0 and then put an M. $440 a month is my minimum. 10 times your age. We used to say that. We used to always say 10 times age. People would be like, well, how much is that? And me and Steven would be like, wait a second, are you serious? 10 times your age. Like, yeah, how old are you? I'm 30. Okay, that's 300. Oh, okay. I can't make this shit up, folks. I'm just saying, like sometimes like we get surprised too, where there's like, oh, I guess they're not teaching simple mathematics in school anymore. They got some new algorithm thing that teaches you absolutely nothing that you can use. 10 times your age, just make it simple. Age and add a 0. That's it. That's your minimum. Okay. So that's the minimum. So that's the first thing you need to do to get started is figure this out. The second thing we want to know when you get on the phone with us is what problem are we solving? If we're going to set this up for you, what do we want to do with this money? Because remember, there's the most important thing with the infinite banking concept isn't the policy. Like I'm talking a lot about the policy because that's what you all understand. You understand it's a whole life, it's specially designed and some of the things about it, but you guys get fixated on the policy. Folks, the policy doesn't mean shit. I don't mean to be rude, but it's just the machine that we take money, we put the money in the policy, we take the money out of the policy, and we make that money go to work. Where it goes next is the only thing that matters. You saw the example I did a second ago where I showed the money moving to the car, the credit cards, and all those other things. That is how you become wealthy. Putting money in a stupid, specially designed whole life will never make you wealthy. It'll make you more than you're making today. But if that's what you're content with, we're probably speaking a different language now. The infinite banking concept has nothing to do with the whole life. It's the process. Folks, you want to get good at this? You want to learn this? Stop asking questions about the policy and start focusing on the process. That's all that matters. The policy, yes, it has to be designed correctly. You want it designed correctly, call us, call an IBC practitioner. Like, we know how to design them right. That's it. We're not going to screw you. There's really, if we do it right, you're going to know right away, because you're going to look at your illustration. You're going to have between 60 and 90% available immediately. After that, like, it's built right. Forget about the policy at that point. Move on to the process. So the biggest thing we need to understand is, what is your goal? What do we want to do with this money? We figure out how much we want to save. Once we know that, the second thing we want to know is, how much do we want to dump in, if anything? Now we've got the chassis built. Now what we need to do is say, all right, what do we want to do with this? And a lot of our folks are coming to us saying, I want to start lending money. I want to be the bank. Banks lend money, and that's how they make money. So I want to do that. Perfect. We've even created the platform. You guys can look this up. It's called Private Money Club. Just put privatemoneyclub.com in, and then the new software is coming. It's where people that have money meet people that need money to lend. It's banking 101. We just created the dating site for it. That's all we did. So now what is the process? The process is this, folks. That's the process. It's simple. Draw a circle. Your money starts on the left side of your circle. Okay. What is the left side of your circle? Especially designed and engineered whole life. We're just going to call this the machine, and the machine is your bank, BYOB. Okay. Everybody understands that. That's the left side. What is the right side? The right side is the opportunity. The opportunity can be many different things. Some of you are experts in different things. Whatever you invest in, whatever you know, like, and understand, that's your opportunity. If it's real estate, perfect. Okay. If your thing is flipping cars, perfect. If your thing is investing in stocks, perfect. If your thing is crypto, perfect. It doesn't matter what your opportunity is. This is the single most important part of this process. Because if we know we can take money out of the policy, and in the middle, we're going to make a spread. So we always know, no matter what, we're making money. No matter what, we're making a spread. And every year that spread gets bigger. It's uninterrupted compound interest. Okay, that's what's happening in this. Whatever the opportunity is, the car, the house, the loan, whatever interest or profit that those earn, once you start your own bank, why in the world, if you made interest, if you made profit, if you had money coming in from your opportunities, why in the world would you put that anywhere else than your bank? So the most important thing is that you practice banking and you're an honest banker. The interest in the profits always goes to the same place it came from. And around we go. We just keep doing this. We just keep adding on. Policy 1, policy 2, policy 3. I like to call it banking office branch number 1, branch number 2, branch number 3. Every one of them are just me opening a new branch, so that then I have the capacity to run more money through my banking system. The more money I can run through my banking system, the more opportunities I can do to make more money. And every single time I do this, I make money twice, and that's it. That's the whole process. That's what you need to really get good at. I know why, and we argue about it internally. I know why all of you want to just ask questions and focus on the whole life. It's what you know. It's the product. It's the same reason when you go to the grocery store, if you're hungry, you buy some Campbell's soup. Okay? You buy the can that says Campbell's soup. It's brand. It's a product. But when you come home and you open that can up and you dump that soup into the bowl, maybe some of you are like those analyticals that say, I wonder how this was made. Wonder if that's organic chicken. Did they go out and run around the field? These noodles, I wonder if these are organic noodles. You start thinking about like how the soup was made, but you didn't buy how it was made. You bought the damn product. So I understand, like, this is the product. This is what you want to buy. But what you really want is the process. The process is what's inside the Campbell's soup. Does that make sense?
Yeah, just they're saying I have retirement and Mass Mutual. Now, can I transfer it into a policy, life insurance? And they're just saying on that, I'm 59 years old, retired last year. Now, how can I remove my money tax-free to work for me?
Okay, so swear word in there, tax-free. So Kenneth, if you've got money in a retirement account, as long as it's not a Roth, if it's in a traditional 401k or traditional IRA, you're never going to get that money out tax-free, ever. If you die, it's taxed to your beneficiaries. It's always going to be taxed. So if you're after 59 and a half, Kenneth, what I'd do is rip the Band-Aid off, man. Set up one of these policies, set up a distribution from your retirement account, which hopefully is not sitting in the stock market, dwindling and going down, 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 and then start taking money out of your retirement account and moving it to a tax-free bucket, which is your bank. I did say that earlier, right? That the money, the internal buildup inside these policies is tax-free. So that's how I would do it. You can't take the money from your retirement, move it to the policy tax-free. You can't do, Kenneth, you can't do anything with the money that's in that retirement account tax-free ever. You already screwed up and you put the money in a retirement account like all of us did. I'm not picking on you because I've got an IRA and I can't get that money out tax-free. So that's option number one. Option number two, Kenneth, is you could roll that money into a self-directed IRA and practice the same process using your self-directed IRA and lend through things like Private Money Club. So that's an option.
Yeah, we did a webinar last Wednesday on self-directed IRA. So I'm going to put the link in the chat box if you missed that one. Go check that out, and then, happy to answer any questions about that as well.
What are your thoughts on running your expenses through the policy? An agent was designing a cash value retirement policy that was fully funded after several years. It was designed to continue pulling out expenses without contributing premium after 7 years. So Harold, that's a great question. And here, let me just show this, okay? This is going to require me just changing my screen here real quick. Let's look at an actual policy. And Harold, what I want you to do is pretend that this is the policy that was designed for you. This is a real policy we designed. So up to this point, we've talked conceptual, but now let's look at real numbers. So this is a guy named Kevin. He was 38 when he started the policy, and this is what it looked like. All right, so he puts 50 grand in. That was his dump in. And then every month he was putting $491.25 a month in. In the first year, he had access to 51,000 of the 55,895. Not too bad. It's 92%. This is a great plan design. This policy, just so you all know, is a company called Lafayette Life. And this is a proprietary design. We call it the Slayer. Just getting into the weeds, folks. I don't usually share that stuff, but that's what this is. So with this policy and with any policy we design, so what you're saying is they designed you a policy that after X amount of years, you stop paying premiums. So that could be one of a couple of different things. It could be an IUL that they just show the premium stopping, but the costs really don't stop. It could be a 10 pay where the premiums stop after the 10th year. We don't really use 10 pays for this anymore because the new 10 pay chassis just isn't as lucrative as what I'm going to tell you about next. Every single policy that we design, if you so desired, and really the only way I could ever see eye to eye with you that this would make sense is in a retirement scenario. So let's just say here, Kevin, and I'm going to use Kevin as the example, in the 10th year wants to retire at 47. Hey, good for him, right? He wants to retire at 47 years old, and he no longer wants to deposit $5,500 into the policy anymore. Perfect. All policies that we design after the 10th year can be RPU, reduced paid up. So what that means is that we can go to the insurance company and just say, hey, Lafayette Life, Kevin doesn't want to make premiums anymore. Can you do a reduced paid up on this policy? The insurance company with a big smile says, absolutely. Fill this form out, send it back to us, and we'll do that. So what would happen to Kevin's policy is year 11 on, he'd never be able to put another dollar in. So Harold, that's kind of what you're saying. You'd never put another premium deposit in. His cash value would still continue to grow. Okay, it would be a little less than what I'm showing because he's not putting new money in, but it would still continue to grow at the same interest rate, the same compounding rates, all things stay the same. One thing changes with a reduced paid up. The death benefit will be reduced. They will take the death benefit where it's at. Let's just say Kevin's death benefit is, I don't know, let's call it 1.2 million in the 10th year. It might come down to 500,000. Again, we don't do this for the death benefit. So if any of you work with us, work with myself or Steven to build your policy, please don't do this as your sole life insurance. That's not what we do. If you want a life insurance policy, like we're not probably the best fit if that's all you want is a death benefit. I would always suggest just buy a term policy to cover your expenses and support the rest with this. But that's just my opinion.
My policies have plenty for what I need. So I don't have any additional, but
mine too. I also have term insurance though. I have two policies, two term policies, about 5 million. When I was flipping a lot of houses and I had a big rental portfolio, I used the term insurance to be there. If I passed, the term would pay off all the mortgages. So Harold, I hope that helps. But I also want every one of you to just for a second, because I know some of you are product nerds, you love numbers. Others are just like, all right, enough of the numbers. Just all I want you to do is focus over here. Cash on cash return. There's two ways you can do returns, and we run into this a lot with clients. A lot of times our clients want to go back to what they've been taught in the Wall Street world, and they do what's called a cumulative return. They sit there and they say, okay, Kevin put 50 in, he put 58.95 in, over 10 years, he put in X amount of dollars, and he's only got X amount of cash value, which means he made a return of 6%. That's not that's not 54%. Chris, where are you coming up with 54%? I understand the cumulative return, but that would only work if you put money into the policy and you just let it sit. Same thing with IRR. A lot of people out there talk about the internal rate of return. We never talk about that. It doesn't even matter to us because the internal rate of return will never be a number I look at because I will never leave my money in the policy. My money will always be out working for me. Every year, whatever cash value I have is somewhere working for me. It's funding my cars. It's funding the copy machine out here. It's lending money to all the people in Private Money Club. My money's always working. So the only return I care about, the only one you should ever care about is cash on cash. And what does that mean? That means in year 2, Kevin, after the second year, he put in $58.95. What was Kevin's return on that year's deposit? So if he put in $58.95, how much money did it grow to, or how much money does he have? $7,141. So he put in $58.95. He now has $71.41. How many of you can put money, $58.95, into your bank account, and at the end of the year at your bank account, you have $71.41 to take out? Anyone? How about your money market? How about your CD? How about any other place you have? Can you put $58.95 in and take $71.41 out? No. That's a 21% cash on cash return. The 5th year, Kevin puts $58.95 in. Now remember, he's compounding on a higher amount each year, so this number goes up. So now his cash on cash is 26. And compounding is a really unique thing because it starts happening faster and faster. It's called velocity of money. Okay, as you start compounding and the balance gets bigger and bigger and bigger, it compounds faster and faster and faster. So therefore, your return goes up and up and up on a cash on cash basis. Year 10, he puts $58.95 in, and he can take $9,122. So let me go back to that one question about retirement. If you had this policy, or any policy for that matter, and in the 10th year, you had to make a decision as to whether or not you didn't want to make deposits or not, you know for a fact you can stop making premiums for the rest of your life. But you look at the numbers, and in the 10th year, if you put $58.95 in, you take out $9,000. How many of you would stop putting money in if that was the math? Because in the 11th year, if you put $58.95 by math, you'd probably have more than $9,122 to take out, would you not? How many of you would stop putting money in? Be honest with me, chat it. In the chat, would any of you not put that $58.95 in the 11th year if you got over $9,000 back? So let me ask you another pointed question. Why in the hell would any agent design you a policy that would not allow you to take advantage of that? They're doing you a disservice. Sorry. Those are the numbers, folks. Straight off the illustration, that's the math. And that's how we do this. And those are the numbers that we look at.
So Kenneth was saying it's in his annuity at 2.3% interest, that money he was talking about, the retirement.
So if it's in an annuity, chances are you have a surrender charge unless you're beyond that. But I mean, you're in a fixed annuity if you're earning 2.3%. I like fixed annuities, but 2.3 still isn't more than what you're getting here. So you really got to kind of just weigh it out. Fixed annuities are great because they're guaranteed, if that's what you have. All right, so do you vet the borrowers in PMC? The answer is no. It is an open community. Now, what we do have the ability to do is when a deal is posted, we have Andrew look over the deals to make sure that they're complete. So obviously, because it's a membership site and people are paying right now $997 a year to be there, it cuts out all the riffraff. So, a scammer's probably not going to spend $1,000 to come in and post a bad deal. But if it were to go up there, we would review the deal. And if it just didn't look right, we're not going to vet the deal. We're not going to underwrite the deal. But if the deal didn't look right, we would remove it or ask questions and then basically hide the deal from the public, from the community, until we get the answers we want. But the answer is no, we do not get involved. It is an open community. Think of a dating site. eHarmony doesn't vet your date. eHarmony doesn't go through and say, well, when you take your clothes off, you got any birthmarks? You got any imperfections? They don't know. They don't care. Well, we don't make you take your clothes off either when you want to put the deal on. It's an open community. We get that question a lot. And I always go back to the dating sites, not because my mind's in the gutter, but just think about it. If you're on a dating site and you go on a date and something happens and all of a sudden now you're going to be a daddy or a mommy, like, do you sue eHarmony because of that? No, you made the mistake. So in Private Money Club, if you lend on a deal and for some reason the deal goes south, don't sue us. Like, we didn't make you do the deal. You were supposed to underwrite it. Matter of fact, we're putting a software on there that's going to help you underwrite it. But just that's how you want to look at it. Just like a dating site for money.
You'll see some like VIP borrowers on there, people that have been doing deals for a couple of years that do a lot of deals on there, have tons of positive testimonials and other members saying, hey, I've been lending to them and love it. People that are family and we lend to ourselves personally. So you can kind of, if you're a little worried, I would always recommend kind of starting with those kinds of borrowers and then expanding out from there, as you go.
I agree. All right. Phyllis said, do you have lenders to refinance a rental to pull out the equity to start a policy? Absolutely. Yeah. I mean, Phyllis, regular banks would do that. We just had another bank on our huddle yesterday, First Savings Bank out in Tennessee. They would probably love something like that. Private Money Club probably wouldn't be the best source for refinancing a rental. Quantum RE could do something like, there's a lot of sources. Private Money Club isn't in the business of refinancing properties, not yet. See, I have big visions for Private Money Club. Today, it's peer-to-peer lending, okay? That's what we are. We are a private lending community. That's what we are. And in the future, I think this is where people will come to get financing for their cars and have other lenders like, private lenders bid on that. I think it will become a platform to finance the startup of your business. There's a lot of different things Private Money Club will become in the future, but today we're keeping it super simple and we're keeping it peer-to-peer lending for commercial properties. And what I mean by commercial is investment properties owned by an LLC. Oh, holographic mind. Stephen and Chris, exactly how private are these policies? Does the government have the ability to monitor our policies? That's a great thing. Do you want to hit that one or do you want me to hit that, Stephen?
Yeah, they're very protected. I could get into that side. The privacy, I believe they're more private than anything. You might be able to confirm that, but they are very, very private. You can't, I don't think they really even have to be reported, do they?
Nope. So there's a reason why the wealthy or family offices call it privatized banking or private placement life insurance. And the wording is exactly why. It's private. Every year, you don't have to report anything. You don't put this on your tax returns. No one's asking you for statements of this. The government's not intertwining because it's tax free. The government doesn't care how much money you have or how much money you're making because it's tax free. So therefore, it is ultimately private. Now, if you're crooked or a criminal, and you go around stealing money and stealing things, can they seize this money if you are proven guilty in court? Sure. But it is protected against judgments and liens. So if you get sued, okay, and I'm talking about like if you were screwing the government, tax evasion, things like that, money laundering, drug cartel, any of those are the things that are going to get you, so this isn't as private. But if you own a company that does rentals, someone slips and falls and sues the company and then sues you personally, they're not getting the money in your policy as long as you're not in one of the states that's not protected, but they're not getting it because it is protected against judgments and liens. All right.
And then we just had Tess and Jean and over in the comments just sharing a little bit about their experiences so far with the Private Money Club and everything. So definitely check those out.
Holographic Mind, thank you for your service. And I want to give a quick shout out to all the veterans and current military men and women. Thank you all for your service. Thank you for keeping us safe and free. Please keep fighting for our freedom. It's going to be a big fight in the future. So I want to give a big shout out and a big thank you to all of our military and ex-military. Thank you. Unanimous said, I currently don't make enough to qualify for one of these policies. From what I understand, I am already 59 and a half and 595 a month is too much at this time. So I was thinking about a HELOC. Yeah. So you could take out a HELOC and you could do the process using your money from your HELOC. You could fund the policy with a HELOC, although that doesn't always work because if you can't just put money in one time, so you got to have the money to save. If you're struggling to save 595, it's not game over for you. What you might need to do is just really do a budget. I always tell people, like in these times, like a lot of people ask us, what is your suggestion to be able to handle these increased costs of fuel? I said, when's the last time you did a budget? Oh, I don't know, a very long time. Well, why don't we start there? Why don't we figure out how much income you got coming into your house net every single month? And then why don't we figure out how much money is leaving your household every month? So if you're pinched at the end of the month and you don't know how you're going to do something, how you're going to pay for gas, how you're going to buy groceries, let's figure out where the money goes first and then figure out on the column where your money's leaving your family, is there anything there that we can start taking back? Is there any way we can start paying things down, taking money back, reducing things? Do you really need Starbucks 7 days a week? Can we cut that down to 4? You know what I mean? So there's a lot of things you can do to make things work, but I can't do that for you. It takes a little bit of due diligence, a little bit of effort, do a budget. And that's what we've got, this brand new thing that's going to be rolled out. And actually, we probably could talk about it soon. It's called the blueprint process. The blueprint is literally going to lay that stuff out for you. And then we have the fractional CFO that would actually help do all that stuff for you. So these are things coming down the pipe that you'll hear about in the next week or 2 weeks that you are all going to have access to. It's very inexpensive. The blueprint process is going to cost you $49. Now, if any of you on here can't afford $49, there's nothing we can do, okay? $49 allows you to walk through a process that I created, okay, with our team called the blueprint process, and that is coming, so stay tuned. The other thing too, some of you are probably thinking, well, hey, listen, this sounds awesome. How do I start this? Stephen will put his link up so you guys can set up a call with us to discuss whether or not this would work for you and what problem it's going to solve for you. You'll see our whole process, because somebody was asking, like, what does the process look like? How do I start? Well, it starts with a phone call. So the link he's going to throw up right there is how you start the process. You will basically set up a call with one of the money mentors, me, Stephen, there's a couple of us, and we will then walk through. And I'll tell you the one thing we will not do on that call is we will not sell you anything, okay? We're going to listen to you. We're going to answer your questions about this concept. And after we've answered all your questions, if you want to move forward, you can ask us to help you. That's how we roll. That's how we do business. We feel if we do a good enough job teaching you how this concept can change your life and solve your money problems, then you should ask us to help you set it up. And that's how we've helped over 5,000 people to date do this. So we're not new at this, okay? We've been doing this for a while, and we've helped over 5,000 people without one negative complaint. So a lot of you are still thinking, oh, that sounds too good to be true. Those numbers from Kevin sound too good to be true. If they were too good to be true, I promise you, you'd find some negative comments on Reddit or somewhere else. There is none, because everything we're teaching, everything I'm telling you is exactly how it works. You can screw it up because you can steal from your bank, but it will still work exactly how we show it if you just follow the infinite banking concept in the process.
Maybe just hit it one time about health. If you're in bad health, we do have solutions for that.
Yeah. So we get it a lot of times. I mean, people want to start a policy. They go through the application process and the underwriting process, and it comes back and they're denied. It's not the end of the world. If you're denied with one company, we just don't say, oh, sorry about your luck. Oh, that sucks. Well, when you get healthy, come back and see us. No. We say, okay, these are the reasons you were denied, whatever they can tell us because of the health, the rules with the health information, HIPAA. We'll take you to another carrier that will maybe insure that risk. And then if we don't get insured there, we'll take it to the other. We'll always try 3. We call it strike 3, you're out. If after 3, we can't get you issued, what we're going to do is we're going to say, what other body in your family or what other body that you have an insurable interest can we borrow? So do you have a child? Can we do a policy on your child? Because if you're denied, the next place would be start with your child. How about your spouse? How about your key employees? There's always a way, but yes, health is important. If you kind of have to look as good on the inside as you do on the outside. Age limits, I don't know. I mean, my daughter was 6 months old when I did her policy, and the oldest one we've done, I think, is 77. They don't look as good, not nearly as good as Kevin's at 77, but it does still work. But at 77, anything over 70 years old, you got to definitely find the death benefit important because the cost to insure a 70 or 77-year-old is more than a 38 or 40 or 50-year-old. So you just have to factor that into the equation. Age doesn't really affect the cash value, but it certainly will make less accessible because the cost is higher. That's all you need to do. So I always say 70 years old is kind of where we start getting into like a little bit more difficult. Plus at 70 years old, a lot of times we're dealing with some health issues. But if you're a 70-year-old running triathlons, shit, let's go. Like we've got a great client. She was, I think, 72 when she started. And if I'm not mistaken, she's got 1 or 2 policies now. Or is there a definition or criteria to use for key employees? Yeah, executive. That's the only thing you need to know. Key employee is executive. If that executive died tomorrow, does your company suffer a loss? If the vice president of lending dies at the bank, does that affect the bank? The insurance company says yes. Does it really matter to the bank? Probably not really, because everybody's a vice president at a bank. And they're a vice president at the bank because that gives the bank the insurable interest to put a whole life policy on them. 59.5, possible to put less than 595. Unanimous, yes, but we won't do it. And I'll tell you why. It just won't work as well. We don't set people up to fail. And if we start a 59-year-old at less than 595, we know it's not going to work. It's going to work, but it's not going to nearly look like what these do. So we would be immediately trying to set you up to fail, and we won't do it. Many other agents and people out there, I guarantee you will, because they'll be hunting a commission. We don't chase commissions. You know, we're just all about solving problems. And if we solve enough problems, then we're all good. Can an 80-year-old father use his son, 49-year-old body? Absolutely. Yeah, unanimous. We do that all the time. We have lots of grandmas and grandpas taking out policies on their children or grandchildren. You just need the blessing of your children if you're going to, you know, take a policy out on your grandchildren. That's all.
Yeah, those policies are great too, man. Like,
yeah. Oh gosh.
If he's available, but I might have it if not.
All right, we're going to show you my daughter's policy. So what we're going to do, this is called, my daughter's name is Viviana. We call her Vivi. We call this Vivi Lucky Jeans because she's going to be pretty lucky. I started this policy. It's not a big one. It's $5,000 a year. Could have been less. I'd say the minimum for a child, I think we just determined this is like $2,000 a year. But I did this policy at $5,000 a year for Vivi. And what the policy is going to be used for is in the future, it'll be used to fund her college, down payment on her house, her wedding. Then it'll be used to fund her children's college education and then her retirement, which you'll see it in just a second here. There we go. Can we make it just a tad bit larger? So here you go, folks. Now, the way that this policy is designed is very different than we would probably design yours, because this is more of a long-term strategy. So how we built this policy, just getting to the nuts and bolts, this policy is done with a Mass Mutual, okay? This is a Mass Mutual plan, and it was done with 40% going to paid up additions, which is not what we normally would do. We would never do 40% for most of you, and then 60% going to base. So many of you would ask, why would you ever do that? If you're watching any of the videos on YouTube, you're like, well, why wouldn't you put 90% to paid up additions and 10% to the base? Because it would never work. And it won't work for the people that are teaching that either, but they just aren't telling you the whole truth. This policy is a 40-60, 40 PUA, 60% base. So let's just run through the numbers. In the first year, she puts in, where I put in $5,000 for, she only had $22.85. So you can see there's less cash value early, but the base, because I put 60% to that, that's the most valuable, powerful thing of this policy in the later years. So when Vivi gets to the time where she's going to go to college, you can see in yellow and highlighted, I take $20,000 out each year for college. Now that could be more. You can see she had over 100,000. She has 108,000 in that when she's 17. So at 18, we can take $20,000 out each year or more. I mean, college probably will be way more than 20. And the way that I've shown this is I show it taking loans, but I show me being a very unhonest banker because I'm never paying any of these back because it was easier to illustrate. So then she gets to the point where she's going to have a wedding. Okay, so at 29 years old, I have her taking $40,000 out to fund a wedding. And again, never pays any of the money out, just steals from her bank. Then when she will never do that, just so you know, at 32, she takes $60,000 out for a house down payment. Let's keep going. As we go down, Vivi's going to have children. You know, dad will be probably gone at this point, but Vivi has children. And at the time, you know, those children go to college, I have $30,000 coming out each year for her child. Then when Vivi retires, and I have her retiring at 64 years old, she takes $90,000 tax-free out each year, all the way to the time when she's 92. So let's just put the math into perspective. At age 90, she would have put a total premium into this policy between what dad funded and then what Vivi funded after dad's gone, $398,000, okay? The total loans that she took out for her retirement or her kids' college, her down payment on her house, her college, and I missed something in there, her college and her home deposit, she took total loans of $2.73 million out. Her cumulative cash value is $5.578 million. So $5.5 million. Which means her net cash value, meaning after all the loans were taken out, never paid back, she has $2.9 million left at the age of 90. So in other words, she could have taken a lot more money in retirement. She could have taken a lot more money out for college. She could have taken a lot more money out for the house down payment. This is just one policy that I started for my daughter at 6 months old, and I put $5,000 a year in. Now, I would ask you, why wouldn't you ever do this for your children? This isn't even a big one. Like, this is one of many for my daughter. And this is definitely not the way I would use it, but it's just the easiest way to illustrate it because I don't have to show any loan recaptures, but that's not the way you would do that.
Yeah, I mean, best business to make money. I mean, If you want to learn how to make money and control money and investing, especially, I mean, you need to come to Buffalo, really.
Yeah, definitely. So,
I don't think we
as you,
talked about that really, but
we haven't, but if you want to learn a lot of this stuff, we've got a live event going on end of July. We've probably not been pushing it hard enough, but now we are going to start pushing it. We've got some unbelievable speakers: Justin Colby, Greg Hurling, Suleiman Hermani, Brent Kessler, Kevin Shortell, Stephen Nagy. I mean, we got a whole bunch of rock star speakers coming, and all we're going to be doing is showing you this concept, the best businesses to do. We're gonna cover everything with money, and the tickets are very inexpensive. Not only that, we've done something really cool. We rented out a TV studio. So like where you would see like a David Letterman style, that's where we're doing the event. Unlike any event you've done, it's stadium seating, okay? And it's going to feel like you're in a TV studio. You have Devin Burr speaking. And not only that, we're going to be doing this live and virtual, okay? So we're not only going to be doing the live event, but at the same time we're doing the live, we're going to be streaming it virtually. So if you can't come to Buffalo, July 30th, 31st, join us virtually. There's how you save your seats right there. The virtual admission is $197. The general admission, there's 61 seats left at $297. And then the VIP admission is $997, and that's 16 left. So the VIP is going to get you on the 29th a VIP trip. We're going to meet here at the offices. We're going to take a limo downtown Buffalo. We're going to watch a baseball game in a suite that we rented out, and then we're going to watch fireworks after that. Not only that, there's going to be food provided during the event, and we've only got 20 VIP tickets, 16 left. So you can see there's the ballpark where we're going to be going, but we'll be in the suite. There's the limo bus we're going to be taking down there. Drinks will be provided for all of you that want some cold frothy beverages. And we're going to have one hell of a time, and that is going to get you one-on-one time with us. All the speakers will be there for the VIP. So folks, don't delay. What's the address of this studio? It's the same address as our location. They're next door. So fortunately, we had a TV studio right next to us. We've just never thought to do an event there. It is a limited event, and yes, you can be an affiliate. That's a whole nother conversation after the fact. So grab your tickets. Time is running out. Flight tickets in the summer haven't been very expensive. We've gotten some of those. We've looked at the pricing from different parts of the country. It's been very inexpensive. And if any of you are like, oh, Buffalo, like, isn't it cold there? Not in July. It's beautiful here right now. Beautiful. Whatever your weather is where you live, it's not as good as it is here right now. I'm just telling you. Stephen lives in Florida, and he's always boasting about his weather. Right now, it's better here, way better. So folks, get here. You will not regret it, and you're running out of time. If I can't attend live, but I want to do the virtual, don't want to register and take a space. The virtual is we can sell thousands of virtual tickets. So Jim, don't worry about taking a virtual ticket away from somebody. So just buy it. Just get your ticket. Yeah, so you just go to Private Money Club for that. I'd like to know, how much do you charge for your services? Nothing. We should have hit that earlier. So Martha, we don't charge to set up your banking systems. We don't charge for that call. That is all just part of it. We get paid by the insurance company. The insurance company pays us 60 to 90% less than they would on a regular whole life, but we make nickels and pennies on lots of people's policies. So that's how we do it. So you'll never write a check to me, to Stephen, to Money Multiplier or Money School. The only check you'll ever write is the deposit into your policy. What would happen if the government decides to alter our monetary system? Holographic Mind, if you've been paying attention, they're going to. They're probably going to come out with a digital currency, and everything will have to revert over to digital currency because we live in the United States of America, and we have to use whatever legal tender they tell us to use. So if it moves to a digital currency, well, the policies will be valued in that digital currency. I mean, unless you plan on going to Switzerland or somewhere else, like, you're going to use whatever the US government decides. So that's pie in the sky stuff and not even worth talking about. We live in the United States of America, greatest country on earth. And in the United States of America, our legal tender is the US dollar. Love it, hate it. This little baby is still the most valuable currency in the world because it is what oil is valued in, and it is the reserve currency used. Now, that will be challenged probably inside the next decade, but as of right now, that's what we got, and that's where it ends. Yeah, and if any of you are interested in Private Money Club, you just go to privatemoneyclub.com. Up until October, you can get in for $997 for the year. It's an annual renewable. But after October, when we launch the new software, it's going to be $14.97. So if you get in at $9.97, you're grandfathered for 12 months. Even we'll give you the new software and everything. You'll be on the new platform when it comes out. So definitely not a bad idea to grab that. The address of the studio, 4545 Transit Road, Williamsville, New York, 14221. So that's the address. But with that being said, folks, I think we covered a lot of ground. We did it a little different, and I hope you all enjoyed it. I hope we answered almost every question that you had about privatized banking, the infinite banking concept, and how this system can work to solve your money problems. The next question is you. Are you ready to take action? Are you ready to do something to change your financial life? Or are you just going to keep doing what you've been doing? Because that's probably not going to work in the future. So be very careful about what decisions you make, what you decide to invest in, and change one thing. And that's where your money goes first, and everything else will change. With that being said, folks, thanks for joining us for another week of Wealth Webinar. Any of you that want, join us for the happy hour this afternoon at 4:30, where we will do nothing but answer your questions. So join us. We'll be there with a cold, frothy beverage. Till then, have a good day.